that I love you? Have I told you there's no one else above you? You fill my heart with gladness, take away all my sadness, ease my troubles, that's what you do. For the morning sun and all its glory greets the day with hope and comforting.
We want to look at F6 chargeable gains. Chargeable gains. Now, there are a number of points about chargeable gains that we would like to highlight here just now. First of all, there is the question of the calculation of the base cost. The calculation of the base cost. The calculation of the base cost comes in terms of reliefs. Right? We have two types of relief. We have, for example, the rollover relief. We have the rollover relief. Obviously, we have other reliefs such as entrepreneur relief. But two major types of relief. We have the rollover relief and we have the helpover relief. The helpover relief. Now, when there is a sale of a chargeable asset, when there is a sale of a chargeable asset by an individual, there is a simple calculation of the gain, which is specifically the sales proceeds. We have the sales proceeds, and from the sales proceeds, we minus the allowable cost. We minus the allowable cost. When we minus the allowable cost, we have the gain. We have the gain, the value of the gain. Now, when there is a reinvestment, of the sales proceeds, for example, if the sales proceeds, in this case, is $10,000, sales proceeds $10,000, and the allowable cost is $2,000, let's say, there will be a gain of $8,000. The chargeable gain will be $8,000. Now, it is possible that part of this 10,000 or the whole of this 10,000 has been reinvested. This 10,000 could have been reinvested. If this 10,000 is reinvested, meaning the money for 10,000 is used to buy another asset, a similar asset in this case, or a similar chargeable asset, what we have is that the amount of the gain, either the whole gain or part of the gain, can be allowed to carry forward. We call it rollover. That is what we call rollover. But the amount of the gain out of 8,000, the amount of the gain out of 8,000 that can be rollover depends on the amount that has been reinvested out of the 10,000. So let us assume that the whole of the 10,000 has been reinvested. If the whole of the 10,000 has been reinvested, then we can say, because the whole of the sales proceeds have been reinvested, then the whole of the gain of 8,000 will be carried forward. In that case, we might say that the new asset, the $10,000, is used to buy a new asset costing $10,000. It means that the whole gain has been reinvested. The amount not reinvested is therefore zero. Therefore, the whole of the 8,000 will be rolled over. But the question is, how do we roll it over? That is where the base cost come in. So what is the base cost? It is the cost of the new asset, $10,000, minus the amount that has been rolled over, 8,000. So we minus 10,000 with 8,000, which is the amount rolled over, and then we have what we call the base cost. The base cost of this asset, therefore, will be 2,000. So the base cost, therefore, in summary, is the cost of the new asset minus the amount that has been allowed to be rolled over. So we can say, what therefore is the principle of rolling over? to rollover, we compare the amount not invested with the gain. And we say the smaller of those two would be charged now and the balance will be reinvested. What do we mean by that? Suppose out of the 10,000 that we get our sales proceeds, if we decided to reinvest not in all of the 10,000, but buying another asset costing $9,500. In that case, what we can say is that this is the amount that has been reinvested. The amount that has not been reinvested, therefore, is $500, making $10,000 the total sales proceeds. Because not the whole of the sales proceeds had been reinvested, what we will do in that case is to compare the amount not reinvested, the 500, with the 800,000. The smaller of these two, the smaller of the 500 and the 8,000 will be taxed now and the balance will be taxed later. What does that mean? That means that out of the total gain of 8,000, $500 will be taxed now, and the balance of 7,500 will be rolled over and will be used to calculate the base cost. In that case, what we are saying is that because the amount that has been rolled over is 7,500, the base cost of the asset, therefore, will become 2,500. So we can see that when we do not invest the whole of the sales proceeds, there will be a restriction on the amount of the gain that can be carried forward. If in this case we made 10,000 and we only bought a new asset costing maybe just 1,500, a new asset, 1,500, it means that the amount not invested, 10,000 minus 1,500, will be 8,500. In that case, the amount not reinvested is compared with the gain. The gain is 8,000. The amount not reinvested is 8,500. Because the amount not reinvested is greater than the gain, the whole of the gain, the whole of the 8,000 will be taxed now and nothing is going to be rolled over. The base cost of the new asset, therefore, will be straight away 10,000 because there is no amount rollover.